welcome to this week's show where we're going to speak to you about positive geared property portfolio. By the end of the show, you are going to know very clearly why you most definitely want positive geared properties and what not to be buying with negative geared properties. So many questions that I often get are, why is positive geared property in your portfolio critical for investors? How can you identify and purchase cash flow positive properties? And the strategies that can be used to pivot your portfolio from negatively geared to positively geared. So, guys, how do you do this? If you've got negatively geared properties, what can you do to use? What strategies can you do to make them positive? My name is Mish Daniel, and I'm the founder of Revolve Commercial. I've been investing in real estate for over 35 years, in commercial for 18 plus years. I have helped so many people create wealth out of commercial real estate. Through this time, we have transacted in over $81 million worth of commercial real estate. In today's show, we are going to be talking about positive geared properties versus negative geared properties. So let's jump straight in and challenge a couple of the ideas that we have on negatively geared properties as a strategy. Now, in the past, many people would want negatively geared properties because maybe their taxes were too high and they wanted to offset their negative geared properties against their tax. Not a bad strategy if you are buying properties in market growth and you have that wonderful problem. People would often say to me, yeah, but I need a mix of negatively geared properties to balance my portfolio. Well, my answer to that is, why would you want to do that? I mean, seriously, because realistically, you're going to work really, really hard to acquire properties, to purchase properties. And at the end of the day, what you're doing is, out of every single dollar that you're making, you're giving back the government 70% per dollar. Okay. And you agreeing to keep 30% of your tax money. I really feel, from my perspective, I would rather invest my time, effort, and energy into keeping 70% of those profits and giving back 30% as required. Okay, so positive geared properties are fairly difficult to find, particularly in today's day and age, where we've got interest rates rising, going through the roof, absolutely going gangbusters right now. Where this is going to go, we don't know. All right, so properties are becoming more and more difficult to find, or rather positive geared properties are becoming more and more difficult to find. How do you mitigate that? Well, listen on, and we're going to go through it. People often say they're buying property for capital gains and cash flow, and cash flow is not their priority. Well, I got news for you. I think if cash flow is not your priority, then you literally are not making money in the strategy that you're doing. So seriously, cash flow is king. All right. Or as has been said in the past, cash is king. So what is the key to generating cash flow on autopilot and financial freedom? So the best ways to buy positive geared properties from the start is using a buyer's agent, getting strategies, tailored opportunities, guidance, advice, using a professional to help you to find the right property, to help you to assist, using a professional that's looking at properties every single day, all day, which is very time consuming, and to make the right decisions. So what exactly is a positively geared property? So let's just run through it. And here we have a case study of a property at 1.690 million. So that's the purchase price. The net income on this property was a sweet 120,000. Now, guys, I'm showing you that net income from at 120K. And realistically, that can replace your income. 120K can replace your income. And for those of you that don't know, I replaced my income within 1 year of doing these strategies after moving here 10 years ago. Okay. On this property, you've got outgoings of $13,000, bearing in mind that net income, you do not deduct the $13,000 off that. The $13,000 have already come off that. So your net income is what you've got left in your pocket. Your cash flow is 92,000 per annum, which is 92,000 after your interest that you've paid on this property, which means that your cash on cash return is 7.48%. So what property information are you looking for? You're looking for high exposure. You're looking for factory industrial. It's what everybody's looking for at the moment. And at the moment, factory and industrial is probably the highest on everybody's priority, because there's a demand, there's pressure on factory and industrial. And currently the statistics are that there is 80,000 square meters of factory industrial short right across Australia. Okay, that's a lot of factory space that is still going to be coming on. You're looking for good solid tenants. You're looking for good solid leases, 5 years, 5+5, in large industry zoned land. If you're ready to own your own property, there's two ways to get a positively geared property. If you already own property, these are a couple of ways that you can mitigate risk, reduce your expenses, and increase your property income. Let's have a look at how you can reduce your property expenses. The first thing you can do is, of course, with rising interest rates, you want to be looking at refinancing, making sure that the interest rates that you're getting are the best possible interest rates that are out there that are suitable to your portfolio, your serviceability. The second way would be to find a great property manager. Now, with regards to property management, you need to understand that the benefit of having a good property manager is that that property manager should be looking after that property as if it's their own property. So they're investing in ensuring that leases are being adhered to, that tenants are being attended to when they're asking questions, that all maintenance is being attended to the minute there are issues, roof leaks, lifting tiles, whatever it is, that your property manager is all over that, on top of that. And bearing in mind that the better your management, the better the value of your property. Because if your management is very good management, for argument's sake, when it comes to having a look at your finances, you should be able to just hit a button, go onto your portal, and print out the history, the finances, the ledgers, the tenant's history, and everything. If somebody ever wants to have a look at your property or look at your profile, you should be able to give them all that information at the tap of a button. And I'll tell you a little story. Recently, I've just purchased a car, brand new car, and they asked me for all of this information. I was like, guys, seriously, I'm just purchasing a car. It's not like, I'm buying a multi-million-dollar property. And they wanted all this information. They wanted to see exactly what my trading record looked like. And fortunately, we've got all of this at our fingertips at the touch of a button, and zoop, came through. And within 24 hours, they had all the information. So that's just a little example, of why it is so important to have a look at this property, to have good property management. Besides that, you want good property management so that when you're refinancing and the bank is asking you for this information, and the same as buying a car, you should be able to hit a button and send it all through easily without any hiccups. Okay, that way they can see that you're on top of it and you know exactly what you're doing. With regards property management, you want to make sure that the tenants are paying their outgoings. You want to make sure that you are receiving the correct incremental increases out of your rentals, that lease reviews are being done. You want to make sure that all of those fine-tuning of every single cent is recorded and is on your ledger. Now, there's a great story of a property that I was buying a couple of months ago. Great little property down on the Gold Coast. And we were about to go to contract, and I started asking for ledgers. I started asking for tenancy agreements. I started asking for leases. And I noticed that they were net leases. And when I asked for the outgoings, it would seem that the no, there were three leases, and out of the one was a net, and two of them were gross leases. And out of those two gross leases, those tenants had been there for over 3 years. They had never, ever paid any outgoings, which means that the owner of this business clearly didn't have very good managers. And clearly, he'd been paying all of the outgoings that went back for 3 years for these tenants, which was a great big whopping slap in his face. And I'm sure he was fairly infuriated when he found out that his administration had slipped up so badly. Anyway, we put a hold on that and we said to him, when you get sorted out, come back to us. Well, he was selling their property at just above 6%, not realizing that two of his leases were gross leases and that he'd been paying the outgoings. And as a result of that, he decided to keep those properties because he couldn't sell them at the rates that he had been getting, which is very difficult to go back to your tenants and say, actually, you know what, you need to start paying outgoings right now. And if it is in the lease, it's just a little bit of a, let's say, awkward negotiation, but it can be done. Always best to use a third person to have that negotiation. So there's something to look out for when you're purchasing a property. There's loads and loads of information that we've given on previous shows with regards increasing value in your properties. Always at your rental reviews, you want to reassess your rentals. And we've got some retail properties that we look after. And the one property in particular, or the one tenant in particular, has been there for 5 years. When we took the property over, their lease had never ever been reviewed. When we reviewed that lease, when it came up for review at the end of that financial year, we realized that the review was $28,000 out. Now, to go back to the tenant and say, hey, you need to pay $28,000 was a little bit of a chunk. So what we had to do is negotiate, because we didn't want to lose the tenant. He was a good tenant. He was a medical tenant, but the previous management hadn't kept up with the incremental increases. The value of the property had gone up because it was in a market growth area. So we had to renegotiate something with them, and they eventually agreed to the rental increase with good solid incremental increases. So it's not what you do, it's how you do it. Adding value to properties, either during the lease or between tenants when tenants move in and out. So there's a couple of ways of doing that. You can always add value when a tenant moves out, is to give the place an uplift, a lick of paint. If it's a fairly large premise, you can maybe subdivide it, bearing in mind that the smaller that your tenancies are, the higher your rental, depending on the type of asset and where it is, what the requirements are. So it's always good to speak to real estate agents in and around the area and ask them the fundamental question: what is the most requested when it comes to rentals and vacancies? What are people most looking for? And see if you can create that out of your property. The other ways of adding values is, of course, adding mezzanine floor in. If you've got the height, if you've got a little warehouse, you can add double mezzanine in. I've seen in 300 square meters of warehouse where they've got a mezzanine floor at the back, and then they've got an office fit out in the front with a mezzanine floor. And what they've done is split that into 3 tenancies. So you've got a tenant in the back upstairs, you've got a tenant downstairs who uses the downstairs office, and then you've got a tenant upstairs. Now that is really splitting up and using all your space optimally and increasing your value. Bearing in mind that for every $1 that you're increasing of value, at 7%, if your property is yielding 7%, it means that the value of your property is going up by $17. The other point that we can speak about is improving your tax situation. This one's a little bit skinny, where the first thing that we always advise our clients do when you settle on a property is do your tax depreciation. So get a commercial depreciation schedule immediately, bearing in mind every single time there's something that's got to be done. So, for instance, when our tenants want a new aircon, make sure that you put that into through the accounts, and you make your accountant aware of that, because you will benefit from having tax depreciation at the end of your financial year, which means that you're going to be making more profits, that tax is being written off. So whatever you're putting in really does drive the value. And the other great thing about that is um, improvements to your property, effectively, number one, are tax deductible. And number two, they're adding value. So you're making your tenant happy by painting it out, putting more new floors in, giving them fresh carpets, a fresh kitchenette, new air cons, um, you know, fixing roofs, things like that. All of that is tax deductible. And it's essentially by putting all those new, I'm going to call them fit outs in, you're adding value to your property. It's your investment. Recap of the key takeaways is most definitely a positive geared portfolio is the key to generating cash flow on autopilot. So what do we mean by that? If you're wanting chunks of cash on autopilot, you want to make sure that you're looking after your properties, that you are getting the correct cash flow, that your management is being adhered to. And when I say adhere to, we have some situations where the management have not been paying strata levies. And suddenly, 3, 4 months later, you get this whopping strata or levy bill that has just come right out of left field that you don't even know about it. Well, you are responsible for that. So you need to make sure that everything is automated. The management system that is being used is being automated, and that all of those sort of expenses are coming off on a monthly basis, so that at the end of your financial year, you don't have to go and pay $30,000 on expenses that you never expected, because that would affect your cash flow. So you want to make sure that it's coming off in little chips, little chips, little chips. And at the end of the day, you can offset that and enjoy that cash flow as it comes through. What are the best ways to buy positive geared properties from the start? Well, you've got various different ways. You can go onto Real Commercial Real Estate and go through it yourself. It's very time consuming, or you can hire somebody to do it for you to try and find those properties. But finding the properties is the easy part. I always say that's the easiest part, is finding the properties. The most difficult part is identifying the red flags. Because once you get into a property, and we see this on a daily basis, where we're looking at hundreds of properties on a daily basis, and these properties look absolutely amazing. They look like they are just going to be cash cows from beginning to end. And as we start digging into the properties, we identify red flags, which are little issues, problems that the agent's not going to tell you about, that the seller's not going to tell you about. They're issues not only in the property themselves, but in the leases, in the intentions for the tenants to stay on, relationships between the tenant and the seller, a backhand agreement that they've made that is a non-disclosure agreement between the seller and the agent. We've just seen the most incredible things come about as a result of just knowing what to ask for and what to look out for with regards, picking up these nuances, they're little nuances. So a buyer's agent is most definitely the way to go. Somebody who's been in the industry for a long time, that knows exactly what questions to ask and how to ask them, and that can provide the right strategies for you, and something that is giving you opportunities and guidance to build your portfolio. If you already have your own property portfolio, there are a couple of ways to pivot your positive geared property to reduce your expenses and to increase your income. So all of those conversations, speak to a professional, speak to somebody who's been in the industry for a long time. It just dawned on me recently that even our legal advisors, so often you'll get a legal advisor. Now, if they don't have experience in actually purchasing property themselves, they might not have on the ground experience of these sort of things that I'm speaking to you about. And it's vitally important that you're surrounding yourself with the right team, a team that can give you those answers, this information that will assist you in your portfolio that will assist you to get cash flow on autopilot. So I hope this information has been helpful to you, and I hope you understand the importance of that positive gear property. And just remember the $1 example that I gave you. Do you want to work for the government, or do you want to work for yourself and give the government a portion of it? And that's the biggest question that you want to ask yourself. As a takeaway, I would like to invite you to go along to revolvecommercial.com.au. There's a wealth grow plan that you can go on. It's 8 simple little steps just to click through, book a call. One of our trusted advisors will take you on a very brief call and get you in front of the right person to see if we can help you, or book a meeting with myself where we go through the strategies. We have a look at your portfolio. We have a look at your at everything where you are and what you want, and we help you get into a positive geared commercial property. If you do already have commercial properties and you want to do something more with them, I'm very happy to help you and create those strategies moving forward.